Hello guys, welcome to today's video where we'll be discussing about shareholders and what share prices are. We'll be discussing the negatives and the positives and going through what it actually means and is. So stay tuned and I hope you enjoyed the video. So what are shares? Shares refers to the ownership units or equity stake in a company or a corporation. This basically means shares are parts of a business that you technically own. When you own shares in a company, you are considered a shareholder and you have a claim on a portion of the company's assets and earnings. So, a share is a piece of company that legitimizes a percentage of your ownership in that company. If you get any majority of ownership in the company or majority stake, you might be invited to the board where you can take more critical decisions in the company. You will, regardless of how much shares you have, you will get a percentage return for buying that share, depending on if the company goes up or down. The losses are also on you. If you have a majority share, you'll get the most profit and also suffer the most loss. Shares are also commonly known as stocks or equity. So who actually buys shares? In the UK, financial institutions such as banks, pension funds, insurance companies own the most company shares. These organizations make profit by buying shares at a lower price and selling at a higher price. Profits go to the investors. So in the UK, there are many financial institutions that can buy shares, but ordinary people can also invest and buy shares. For and against shares. Investors get returns from the profits received by the company. Some investors may seek quick returns and some may invest long term. So the investors seeking quick returns would buy a share, for example, they would buy a share in the morning, and if the value increases, they will be paid a little. Then they would sell that share maybe in the evening or in a few days. There is substantial risk if the company doesn't perform well, gets less profit, as the returns will be less, but other external factors, such as the economy, can be at fault. So, shares are also considered risky because everything else around the business also affects their price and how much they're valued. For example, the demand, the price, how much the share is demanded also affects the price. If the demand is high, the share goes up. And if the demand is low, the share may fall in value. Shares and shareholders. Ordinary shares are the most risky type of shares as the dividends are not fixed. So they can be extremely rewarding if the shares do well and extremely devastating if the shares fall in value. Shareholders are the people that can be paid a certain dividend according to the amount or percentage they own. If you have majority share, you could only have 30%. That's still considered a majority because you have the most shares. Then you would be paid the most according to your shares. Majority shareholders will get a seat on the board where they will receive an AGM, an annual general meeting, about the company's finances and get to ask questions. The majority of shareholders essentially get invited to a meeting to know more about the company so that they can effectively analyze if their shares are going to do well or not, or if they should stay in the company or not. Influences on share prices. Two major factors that affect share prices are a company's performance and the business environment in which it trades. Public companies must publish their financials at the end of every quarter and provide trading updates twice a year. Companies must also give regulatory announcements, which is an announcement on anything that could affect the company, such as a loss that was recorded or employees quitting because of the terrible work culture, so on and so forth. Effects of share prices on a business. Rising share prices means the company is doing well and that the investors are confident in the company and reflects the successes of the company financially or otherwise. Otherwise, referring to if you have signed a new deal or bought a new company, anything that's considered a success. Falling share prices may be caused by a short-term issue, but it also makes the company susceptible to public scrutiny and targeted as underperforming, and may even result in a takeover if the company is underperforming for long enough. Some examples include when the Boeing 737 MAX 8 aircraft crashed and it caused Boeing shares to decline because, people were less confident in the company in making new planes that actually work. Facebook shares fell after news got out that data was being shared with Cambridge Analytica, even though data wasn't meant to be shared. So investors specifically, lost confidence in Facebook because they knew that people's perception of Facebook is now that they leak their own data and people will trust Facebook less. Volkswagen installed a software to cheat on emissions tests, and when people found out, it dropped the share prices because people were less confident that Volkswagen would keep competing would keep making cars that could pass tests effectively. Thank you guys for watching. I hope you enjoyed the video and you learned something new today. Please hit that subscribe button and like, and thanks again for watching, and I hope you have a good day.